The Moving Average Convergence Divergence, MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. Developed by Gerald Appel in the late 1970s, it remains one of the most popular tools for identifying trend direction, momentum, and potential reversals. The three components of MACD. The indicator is typically displayed in a subchart beneath the price action and consists of three elements. 1. The MACD line. This is the heart of the indicator. It is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. 2. The signal line. This is a 9-period EMA of the MACD line itself. It acts as a trigger for buy and sell signals. 3. The histogram. This represents the distance between the MACD line and the signal line. When the MACD is above the signal line, the histogram is positive. When it's below, the histogram is negative. How to read the signals. Traders generally look for three types of signals when using MACD. Signal line crossovers, the most common signal. A bullish crossover occurs when the MACD line crosses above the signal line. A bearish crossover occurs when it crosses below the signal line. Zero line crossovers. This indicates a change in the trend direction. If the MACD line crosses above the zero line, the short-term momentum is now higher than the long-term momentum, bullish. Below the zero line indicates bearish momentum, divergence. This occurs when the price makes a new high or low, but the MACD does not. This often suggests that the current trend is losing steam and a reversal may be imminent. Implementation tips. While the standard settings are 12, 26, 9, many active traders adjust these periods to fit specific strategies, such as scalping or swing trading. Because MACD is based on moving averages, it is a lagging indicator AE, meaning it follows the price rather than predicting it. It is often most effective when paired with a leading indicator like the Relative Strength Index, RSI, or used to confirm breakouts from support and resistance levels. In a choppy or sideways market, MACD can produce whipsaws, false signals. Because the MACD is a lagging, trend-following indicator, it is most effective when paired with tools that address its weaknesses, specifically its tendency to whipsaw in sideways markets and its lack of insight into price volatility or exact overbought/oversold levels. Here are the most common indicators that complement the MACD. 1. Relative Strength Index, RSI. This is the most popular pairing. While MACD measures the relationship between EMAs, trend, and momentum, the RSI measures price change speed, overbought/oversold. The synergy, MACD, confirms the trend, while RSI tells you if that trend is getting exhausted. Trade signal. Look for a bullish MACD crossover while the RSI is rising from an oversold position below 30. This reduces the risk of buying into a trend that has already peaked. 2. Bollinger Bands. Bollinger Bands add a layer of volatility that the MACD lacks. The synergy, MACD, signals the direction of the momentum, while Bollinger Bands show the range of price movement. Trade signal. A powerful setup occurs during a squeeze when bands tighten. If the price breaks the upper band and the MACD histogram is expanding upward, it confirms a high momentum breakout. 3. Average Directional Index, ADX. The ADX measures the strength of a trend but not its direction. The synergy, MACD, tells you whether to go long or short. ADX tells you if the trend is strong enough to bother trading at all. Trade signal. Only take MACD crossover signals when the ADX is above 20 or 25. If the ADX is low, the market is likely ranging, and MACD crossovers will frequently be fakeouts. 4. Volume Weighted Average Price, VWAP. For day traders, VWAP is a crucial baseline. The synergy, VWAP, acts as the fair value for the day. MACD signals can be used to time entries when the price returns to or bounces off the VWAP. Trade signal. If the price is above the VWAP, bullish bias, and you see a bullish MACD crossover, it provides a higher probability long entry than a crossover occurring below the VWAP. Comparison table. Why pair them? Indicator type. What it adds to MACD, RSI. Momentum oscillator identifies overextension, overbought/oversold. Bollinger Bands. Volatility shows price limits and potential breakout zones. ADX. Trend strength filters out weak, sideways trends to avoid whipsaws. VWAP, benchmark, provides a true average price for intraday context. Pro tip for custom scripts. When building a rule-based strategy, try combining trend plus momentum plus strength. For example, 1. Trend price is above a 200-period EMA. 2. Momentum, MACD bullish crossover. 3. Strength ADX greater than 25. The most effective way to combine MACD and VWAP is through a Momentum-Trend Convergence strategy. This approach uses VWAP to define the territory, the trend, and the MACD to provide the timing, the momentum. By combining them, you solve the biggest weakness of each. VWAP prevents you from trading against the institutional trend, and MACD prevents you from entering a trade too early before momentum has actually shifted. The VWAP-MACD cross strategy. This strategy works best for intraday trading on 2-minute or 5-minute time frames. 1. The setup, defining the buy-sell zone. For longs, price must be trading above the VWAP. This ensures you are only buying when the volume-weighted momentum is bullish. For shorts, price must be trading below the VWAP. This ensures you are only selling when the volume-weighted momentum is bearish. 2. The trigger, the MACD momentum shift. Once the price is in your zone, you wait for the MACD to provide the entry signal. The entry. Wait for a MACD signal line crossover that aligns with the price location relative to VWAP. Example, if price is above VWAP, bullish zone, you wait for the MACD line to cross above the signal line. The confirmation. Look for the MACD histogram to start increasing in height. This shows that the gap between the averages is widening and momentum is accelerating. Step-by-step execution rules. Phase. Bullish, long setup. Bearish, short, setup. Zone filter. Price stays above VWAP line. Price stays below VWAP line. Wait for price pullback toward VWAP. Price rally toward VWAP. Entry trigger. MACD. Bullish crossover. MACD. Bearish crossover. Stop loss. 1 to 2 ticks below the VWAP line. 1 to 2 ticks above the VWAP line. Profit target. Upper first or second STD. Dev band. Lower first or second STD. Dev band. Why this is a rule-based winner. Statistical edge. By using a fixed risk model, e.g., risking 1.25% of your balance, the VWAP provides a very clear invalidation point. If price crosses back over the VWAP against your trade, the thesis is immediately proven wrong, allowing for a tight, disciplined stop loss. Filtering false signals. MACD crossover happens frequently, but many are fake-outs. By only taking crossovers that occur on the correct side of the VWAP, you filter out a massive percentage of losing trades. Institutional alignment. Since large orders are often executed relative to the VWAP, you are essentially using the MACD to hitch a ride on the back of institutional volume. Advanced optimization. To turn this into a professional-grade system, consider adding an R multiple target. For instance, if your stop is 10 cents below VWAP, your first profit target should be at least 20 to 25 cents away to maintain a healthy risk-to-reward ratio.